Hey everybody, Kevin here with another Note Investor. Well, it's not a tip of the day, is it? This is another episode, I should say, of the Real Estate Without Renters podcast for you. Thanks as always for listening to the show and sharing it with a friend. So if you belong to a meetup group, if you go to investment club meetings of any type, I really appreciate you sharing the show. And if you enjoy the show, always appreciate those rankings and ratings. I looked at them just last week, and thank you so much for all the 5 stars. I do appreciate that. And that enables me to bring more and more guests to the table here. And I always want to have good, creative guests that know their business. They're professionals in the industry, everything that's in and related to note and note investing. And of course, I have another great guest for you today as well, who I'll introduce to in just a minute. I'll be doing some events. I'm coming up in South Carolina. If you're up in the Columbia area, it's a little late for that one, but I'll be up there on the weekend of the 6th and the 7th, which might be a little too late for this broadcast here, but I'll be also doing a couple of masterminds, and I'll keep you posted as to where I'm going to be. But as always, you can go to my website, which is realestatewithoutrenters.com, or Kevin Shortell. Remember, that's SHORTLE.com, and find out more information. And also, don't forget, if you're still new to notes and want to get more information other than just listening to podcasts and looking at my YouTube channel and doing your own research, I wrote a #1 bestseller on Amazon called Real Estate Without Renters, and you can pick that up at Amazon.com, of course. So do appreciate that as well. All right, I want to introduce you to a guest, somebody I've known for years. Unfortunately, haven't seen for quite some time, but a well-respected professional in the self-directed IRA 401k space, and that is Jack Kiley from MidAtlantic IRA. How you doing, Jack?
I'm well. How are you?
I'm doing fantastic, and again,
Good.
good to see you. I know we had a minute to chat before we got rolling here, but we used to see each other a lot at conventions, and I think we won a couple of awards together at some of those events as well, which is
Yeah, if we didn't, we'll make it up. That's
I think I got a photo somewhere I could look up and prove it. But awesome. Good to see you. And the self-directed space is just becoming more and more important for investors, isn't it? I mean, you see some scary stats when you look at the government. You're going, oh my gosh, Social Security. What are we going to do? And people are relying on that. I mean, you really have to build your own retirement today, and that's the name of the game, right?
no, it totally is. And people are coming to alternative investments in droves, quite frankly.
Mhm.
A lot of large pension plans have been in this space for a long period of time. Some of the largest plans, like CalPERS in California, and some of the other Texas Teachers Union, and a couple of other ones have been invested in note pools and rental pools and all those sorts of things for a long period of time, because the reality is the cash on cash return, on an average stock and bond, is about 4%, and that's not enough cash to pay the pensioners. They need
Yeah.
something higher. So note pools in particular, something usually double that, as far as a cash return on the investment, makes a lot of sense to those big pension plans. So
Wow.
this is not this is I mean, this has been around for a long period of time, and it's sort of dripped in to smaller, to individuals, right? And when you and I were doing the dog and pony show, uh, self-direction was not well known, and
Right.
it's a much more known commodity in the last probably 10 years.
Wow. You're the first one, I have to say, that has mentioned this, which surprised me a little bit. So big companies like the ones that you mentioned, and big investment funds and such with teacher pensions and such, they're into the alternative investment space, huh? And
Well, so right. So what happens? They have a large, retirement plans in general are governed by, a couple of we serve a couple of different masters. One obviously is IRS, which everybody knows about, but in the plan world, it's Department of Labor, and a lot of large pension plans, and again, you think unionized plans, and I mean ones that are in the billions of dollars,
Sure.
they usually have about a 10 to 20% component of alternative investments,
Hmm.
which again could be note pools, private REITs. Okay. I mean, you'll hear like such and such has 1,000 doors. Okay.
Mhm.
A lot of their money is coming from retirement plans because again, the cash on cash return on that is much higher. And you have to remember that those pension plans have to pay pensioners, right? You know what I mean?
Yeah.
So they've got to, the appreciation of assets, for instance, in the stock market, it's going nuts. But the reality is, if your dividend is 4%, that's all you got to kick out to the to the pensioners.
Beneficiaries, yeah. Yeah.
Yeah. So people have seen that in large plans. It's sort of bled over into retirement, smaller IRAs and those sorts of things. As people roll money out of large plans, they'll say, "Hey, we had something like this in the plan. What can I do?" And that again, that gets into self-direction. And of course, as you and I know, anybody involved in real estate has known about this for a long period of time.
Right. So you think that in general, private individuals who want to build up their retirements and get into the self-directed IRAs, the ones who get into that really are looking more at the alternative space because every other plan is basically stock market, pick a mutual fund, that sort of thing. And I bet your experience is similar to mine, where just there's so many people who are just tired of the stock market because they feel it's just a rigged system. It's like they have no control over anything.
Well,
And you have a social media today where a CEO makes one comment and the stock it's like,
right.
what do you do? Where at least with these alternatives, especially notes and real estate, which I'm assuming have to be probably two of the top ones. I don't know, maybe precious metals is in there and such now too. But gosh, I think there's just so much more control and so much less risk in those. Is that really
Well,
the general thought process on that?
well, I think what happens is, one of my taglines is in self-direction you get to leverage your knowledge, right?
Mhm.
So I think what you have here is people end up investing in things that they have either a little more intimate knowledge of or a better handle on.
Mhm.
The reality is in the stock market, as you alluded to before, theoretically we all get information at the same time, right? I'm sure, you know, Larry Fink at BlackRock gets his information just slightly
A little bit
faster
more.
than
Yeah.
Jack Kiley does. Okay, but
Probably.
but theoretically,
Yeah.
we're all getting information at the same time. And when I go to events, people ask me about this, and I poll the audience. I say, "And who here works for a Fortune 500 company or a publicly traded company?" And there's always a couple that raise their
Sure.
hand. And I say, "What do you really know what goes on at that company?" And the reality is nothing.
Yeah.
Okay. Stocks go up, stocks go down. And I'm not saying that there's not a place in your retirement plan for stocks and bonds.
Sure.
But generally speaking, people who invest in things that they understand better, i.e., notes or real estate, which tend to go hand in hand.
Sure.
Okay. You're going to, first of all, you're going to do better due diligence on your assets. So you're probably going to invest better. You're going to mine the shop better because first of all, and second of all, it's something that you're interested in. And it's an iterative process. You're watching it all the time. Most people, I'm a CPA by trade, okay? And I can tell you, most people during tax season, when I talk to them about taxes and whatnot, and the retirement plan comes up, that's the first time this year that they've looked at it is when they get tax documents. And they sort of view this as a passive investment tool all the way through. And the reality is, if you're talking about your familial wealth and you're talking about growing your piece of the pie, so to speak, your retirement plan is most likely your second biggest asset behind your home.
Yeah.
So the idea that that should all be in stocks and bonds or bills and somebody else should be watching that is foolish, in my
Yeah.
opinion, right?
Yeah, good point. Where it's
So
like where somebody feels, well, I am saving for my retirement because I'm just contributing to this IRA. What's it invested in? I have no idea, but I'm putting money there. Should
yeah,
really the mindset be I need to be actively pursuing that, because I do have to look at that as, like my house. I mean, I want to make sure I'm building equity in the house. I want to pay attention to the market. That makes a lot of sense. Yeah.
Yeah, absolutely.
Yeah. Yeah. I used to, in my training classes, I would say it, I guess, a little bit a different way, but along the same lines, I think of what you're pointing out, which is I ask people, so what do you invest in? Well, I invest in stocks. Okay. So let me ask you a question. Before you buy a stock, you research, what they do. You look at their financials. You know what their future, R&D is, for future growth. You know about the CEO and their background and who's running it, right? Of course, the answer is always like, no. I heard about it on the subway or something.
Right.
Somebody mentioned it in passing, and yeah, so I just jumped in and bought some. It's like, that's crazy. Wouldn't you rather have something that's going to be setting you up potentially for the rest of your life down the future? Something that you're familiar with, and or at least that you can get educated in. I mean, so these alternative investments, there's a lot to explore. I mean, I know we're referring to real estate and notes, particularly in this case, but if you don't know anything about real estate and notes, again, you can get started in that and then start to explore it, and then you can start to apply what you learn. So if these are some areas that make sense to you, then by all means research those. But the point being, you'll be able to control things, and you will know if you buy a note, especially if you're working with someone like me, you're going to know everything about not only the note and how it was written up, but you're going to know about the pay history, about the borrower. You're going to know about the collateral backing the loan is, what that's worth. You're going to know everything, and you're going to go in there much safer and
And
really with a higher return.
and that's the point of self-direction. If and I'll tell you personally, I'm a note investor as well, and I really, with respect to my retirement plan, I like notes because it is all the work. First of all, it's all about numbers. So I'm a bit of a gearhead.
Mhm.
So I like that. It really takes the emotion out of it. I don't have to worry about a tenant coming up to me and crying the blues about payments and those sorts of things. And so I really like notes from that perspective. Second of all, if you're looking at a few different things, and everybody's appetite's a little different. So somebody might like a property, single family in the middle of Ohio,
Mhm.
and because they live there.
Mhm.
Okay. And they're much more comfortable with that than, say, a property in Florida. Okay. Other people have different feelings about that. Again, I live in the DC area. I would I there's everything is expensive here. Okay. So this is an investment that allows me to invest, and I don't have to invest copious amounts of money in a single note in areas where it's much more affordable.
Mhm.
And I find it to be just a much better investment, at least for me, because here again, the work is done up front. It's about numbers. It's about looking at the value of the security, which is the property. Do I like that? Don't I like that? Have I had somebody go buy it? All those things that I know that you go through with people,
Mhm.
and then we're basically down to, what do I offer? And it is, what do I want as a rate of return for what I'm getting?
Mhm.
And it's just about cranking a couple of numbers, and it's pretty easy.
Right. So if people have money invested in MidAtlantic IRA, you act as their custodian. Can you give us a brief, I think a lot of people know, but just in case there's some people who don't know, what is your role in working with people with self-directed IRAs?
Well, we are primarily the dotters of I's and crossers of T's, as I say. Okay. So our goal, right, or our mission is to help you invest, or help somebody invest in what it is that they want to invest in.
Mhm.
There's two broad sets of rules, and quite frankly, neither one of them really get touched when we're talking about buying existing notes. One of them is permissible assets. Notes are well within the permissible asset spectrum. fact, IRS only says that you can't buy two things. Okay, we don't need to go into all that.
Mm-hmm.
The other set of rules deals with what are called disqualified persons, and these are people that the IRA cannot transact business with. And most of those, the biggest piece of that or component of that tends to be family members. And here again, when you're buying notes in the open market, generally you're not buying your son's note. Okay.
Right.
So, so again, you sort of steer clear of those two broad parameters. And then really what we're doing is we're looking at to make sure that your funds are transferred in a manner which doesn't put you at risk. Where we're a little different, I think, from most other providers is that we want to know when a client is beginning the process. Okay, so we want our client to call us at the beginning and say, "Hey, look, I'm looking to invest in notes." That
Mm-hmm.
does two things for us for our acquisition. Yeah, well, that does two things for our acquisition team. First of all, you're on our radar screen. Okay, so if I know today that I got 50 deals that are going to be done a week, that need to settle or transact a week from Friday, they're all going to get done. There's no, as my kids would say, there's no drama around
Mm-hmm.
that. Okay. Second of all, it allows us as the process moves on, make sure that everything is in place. So for instance, where are we going to wire money? What are the documents that need to be reviewed? All of that is done in advance. And most of our competitors don't want to see any of that stuff till you have it all together. The challenge especially for people that are new to any asset
Mm-hmm.
class particularly, is they don't even know when they have all the documents together. So you're sort of in this, maybe I do, maybe I don't. You submit it to the custodian and they go, we need ABC. And you kind of go, well, I thought I had it there. And it delays things. And in this asset class particularly, you can't waste time. You gotta know when. Once you make your decision, money has to move from account to account or point A to point B, and that allows us to do that. Secondarily, our office is in the DC area, and I know it's been a while since you've been to DC, but one thing about DC, kind of like Florida, we don't get a lot of snow. Okay. But when we get a hint of snow in the weather forecast, this place locks down. You'd think we're going to have a hurricane. There are people that are running to the store to get bread and milk and all these things. And this place locks down. Somebody in Florida or Arizona doesn't care that we got a weather event. They just need their deal to close, right?
Right.
So if we prepare for all those things, and it'll be funded earlier, we'll take care of it around whatever the environmental factors are.
Right.
So it really helps us to get involved early, and also every investor has a different way of doing things. So some note people use you, some use another guy, some use another guy. And, we get familiar, or we try to in our acquisition team, put, find centers of influence, let's say.
Mm-hmm.
So if we have, 25 people that have learned the Kevin Shortell way, we put them with the same acquisition people because we know the drill. Okay.
Right.
We know how the Shortell
Approaches
contingency.
and sure. Follow through. Yeah.
Yeah. Yeah.
That's
And
that's a great point.
again, that helps us. That helps us.
Oh, to illustrate perfectly your point and how important this is, there is a bit of a dance behind the scenes, everybody, on these closings. You're boarding the loan with the servicing company. They have to be prepared. You've got a seller who's waiting for funds. The seller's got to sign documentation. You're getting the thing coordinated. 2 months ago, I had a client of mine who's using a self-directed IRA, not with you, with another company. And nice note. It was actually 2 notes from the same seller on 2 lots in an area that was, it was just a really good deal. And I was happy for him that he found it. And going through the process, got the offer accepted. We've done all of our due diligence. That's all in place. And again, now all the paperwork's coming together. we had some external reports coming in, BPOs, those sorts of things, and got it all together. And the custodian in that case was just nitpicking. Well, we need this, and you get that done. They're like, okay, several days go by. Now we need this. And, finally, the seller, he goes, I've closed a bunch of notes and I don't know what, what they're asking for, what's going on. And that made my client look bad. And at some point in time, all of a sudden, the seller comes back and says, we're pulling all our notes off for sale, which I knew he wasn't telling you quite the truth there. I knew he was pulling this away because he was tired of going through all the rigmarole. And that's the big rub point for people in the industry, is people who are not closing transactions. So you're 100% correct, and obviously
Well,
know the business on the note side too, because
well, it's like it's
they'll
death by
drop
a
it and just
thousand
say, we're
cuts.
done. We're
Yeah,
tired of playing around. We'll go with somebody
yeah,
else. We got other people
yeah,
here. Yeah.
right.
Yeah.
And we have, we a lot of people on our acquisition team have come out of two areas. At Mid-Atlantic, I can tell probably two of our biggest, or far and away, our two biggest asset classes are real estate and notes.
Mhm.
Okay. And most of the people on the acquisition team have come out of like loan processing and closing, real estate closing. So they're already familiar with deeds of trust and all this, so they're looking at things. And again, you're you're helping the client assess whether it's a good deal or a bad deal. Our job is to make sure that we have the documents that we're supposed to have.
Yeah.
Okay.
Yeah.
And but we have people here that know what they're looking at. Nobody's learning on your clients. That's my point.
Yeah, it's and going back to that previous case study, I told my client, of course, let your custodial know ahead of time that and he said he did. And he said they're just waiting for the paperwork, and there you go. It goes right to what you were saying, and then boom, thing falls apart. That was that was a big bummer. So yeah, that is important, and knowing the space, so important. And boarding accounts and things like that. If people want to do rollovers, same thing. You make that process easy, and once it comes out of their current accounts, roll it over. Now they can self-direct it. What are your thoughts on checkbook control or non-checkbook control?
Well, I think it's a double-edged sword. Okay. So for people who are well versed and comfortable in whatever it is that they're doing, it makes sense. Okay.
Checkbook
Provided,
control does.
yes, provided they're people that are, and I say this in presentations all the time. If you came out of the military or you've been in a regulated industry, you're probably going to be okay with it. Okay. If you're back of the napkin, art of the deal, seat of your pants kind of person, you're going to struggle, because the challenge here is that all the rules attendant to the IRA, okay, now fall to the LLC or the manager of the LLC to know, because the single member owner of that is a retirement plan. So it needs to be treated the same way it would be treated if it was, for instance, with us. Secondarily, and a lot of people don't, sort of don't tangentially think of this. If if you are if you have a checkbook LLC, okay, you're the bookkeeper, right? You've got to keep a set of books. You've got to reconcile accounts. You've got to do it's a company, basically. Okay. So you've got to pay somebody, or you've got to do that work. Okay. If your account is just in at the custodial level, let's say, obviously we're doing, so you're not, I guarantee you we are cheaper, okay, than paying a bookkeeper to do that, or you spending your time doing that. So that's sort of the two sides to it. In again, if you're doing something, or your investment has a lot of moving parts, okay, it probably makes sense to have the single, the LLC or the checkbook construct, because you've got to, you've got to move fast. And I always use the example of a rehabber. Okay. You know,
Yeah.
rehabbing probably makes sense to do in a checkbook IRA, because you got to pay the plumber, the mason guy, the this guy, the that guy, and of course those guys all live hand to mouth, so they want to be paid right when the job is done.
The
Notes,
unexpected pops up.
right,
Yeah. Yeah.
right. Notes, not so much, because it's a passive investment. You could certainly do it, okay, through an LLC, but basically, you're buying, selling, okay, and really the selling part is easier than the buy. You know, again, because we start at the beginning of the process, it's not as painful as it is at other places. It's sitting with the loan servicing company, so the account is just catching payments, right? There's not a lot of moving parts aside from the acquisition,
Mhm.
okay? And people will say, well, you're the cost of the custodian and all of that. And I think if you looked at it on a percentage basis, whatever the value of your assets are versus what you're getting, and especially if you're somebody that buys and sells actively, it's probably relatively inexpensive. Okay. And the other thing is, so people will say we have two fee methods for administration. Okay. One we refer to as per asset, meaning it's 350 per asset, doesn't matter the value. And the other is based on value. So if you're turning things a lot, you want to be on value, or if you have a lot of notes, might want to be on value. And people will say to me, well, the value is it's costing a lot of money. And the reality is, it first of all, the value of the note is self-reported. So you're telling us what it's worth. It's not like we're going out and auditing it. Okay. Um, so, you might be able to control that a little bit, but again, generally, if you took the total cost of administration divided by the fair value of the assets, I think you're pretty inexpensive.
Yeah. And there could be some mistakes that people make with checkbook control that could get them into trouble.
Well, I get asked we get asked, I shouldn't say I do. We get asked to take over custodianship of other LLCs and other custodians and those things. I probably look at, I don't know, 5, 8, 10 a month. Okay. And it's simple things that trip people up. For instance, I can't tell you how many people forget to register or pay that $50 fee to the state to keep it in compliance. Okay, to just keep it running. If you don't pay that fee, the thing, it's your charter's forfeit, and everything has been distributed to you as the beneficial owner. So there's a little problem. The other one that I see is many times there will be debt inside of these LLCs. Okay. So it might be something like a credit card. And I will tell you, 100 years ago, when you and I first started in business, you could probably get a commercial credit card without personally guaranteeing it.
Right.
Okay. I am unaware of any credit, because I've tried. I
Yeah.
am unaware of any credit card that I can get, even in my company name, that I don't have to personally guarantee.
Right.
If I'm personally guaranteeing it, that blows the whole thing up. So it's little trippy things that
Yeah.
that could
I
could
I
cause
read
you a lot of
one.
problems.
I read one, and maybe you've heard of this too. Um, Guy has a checkbook control, and he overwrote a check, didn't have the money in there, and he had his bank had it automatically set up to take money out of his personal account to cover any overdraft.
Yep.
And because that happened, that put him in violation.
Yep.
And it was just over something as simple. And I could see where somebody just, I don't know, it just covered it automatically. He didn't say cover it out of that account. Check didn't bounce. Check went through because it was covered with the personal side of
Right.
it.
And
So,
and again, the challenge with LLCs, the structure, the entity structure is easy. It was designed to be easy. So if I have a company or I have an investment entity that's an LLC, I can take distributions out of it. I can put money into it. I don't have to really go through a formal process. My bookkeeping is, it's got to be formalized. I got to make sure that contributions don't end up on the expense side of things and all that. And, but the construct and the operation of that entity is very easy. And people who have a lot of LLCs, like me, and other people who are in real estate and other ventures and those sorts of things, are used to to moving money from point A to point B to point C, because it's very easy to do. Okay. With LLCs that involve IRAs, you really need to be careful, because that moving around of money just causes issues. So and I think there will come a time where, and we had this conversation internally. IRS, this is not a big thing on their radar screen. Okay. And and it may or may not be over time. But at the custodial level, a lot of what do we really get? What we see is the money going in, and that's basically all we see. We require a fair market value, okay, on the LLC, which again is not hard, okay. But I think we're in the compliance world, we're getting to the point where we are going to require a set of books. So we're going to require a balance sheet and a profit and loss statement, at least on an annual basis. And I will bet you that probably half of the people out there that have single member LLCs don't have one. Okay. And that's there. And, so we're sort of talking about this on the industry level, because that at least forces people to formalize what they're doing, if they're not already, and a lot of people probably are, but,
Sure.
People are people.
Yeah, and one other topic I want to hit with you, and again, we're talking with Jack Kiley at MidAtlantic IRA. And what's the website again? It's
MidAtlantic
Okay,
IRA.com.
MidAtlantic IRA.com, by the way, and that'll be on the website. I'll post it on the YouTube channel as well for more information. But I think people lose out on understanding they can open 401ks too with their own business. So typical example, a lot of note investors form single person LLCs, 100% correct. And they may have a regular job, and maybe they contribute to a 401k at that regular job. Maybe they have an IRA. They can still open a 401k with their note investment LLC, right? Tell us how that might work and what restrictions we might see.
Okay. So, there are, retirement plans fall into two broad categories. You've got individual retirement plans, which are IRAs and Roth IRAs. And then you have company sponsored, or business sponsored is probably a better way to say it, plans. And those might be SEPs, simple IRAs, or solo 401k plans, and what we're talking about. So the first driver to that is you have to have a sponsor, which is a business. So if you are in the business of notes, and that's not the note, the note investments per se, that is in the business of buying, selling, commoditizing that, then that's a business. All right. And the business can sponsor the retirement plan. So many people have 401k plans, and this business, and it doesn't have to be an LLC, it could just be a sole proprietorship. So corporate structure or business structure doesn't really matter. The focus is that it's got to be a business. So when you're thinking business, putting my CPA hat on here for a moment, you're thinking about anything that you pay Social Security and Medicare tax on. So if it's an S corporation and it pays a wage to you, you pay Social Security tax on that. That's the driver for making the contribution to the plan.
Mm-hmm.
If it's an LLC or a sole proprietorship, your net income from the entity is your pay, and I'm using that in quotes, okay? because you pay Social Security and Medicare on that. So that's the amount of money that you, or your compensation, if you will, that you use for making the calculation. So for people who have a day job, for instance, and they have a side, this side investment business or this business, this is a nice way to effectively move money from your right pocket to your left pocket, right? From your taxable pocket to your tax deferred, or if you're interested in Roth components, tax free. So you're doing what I call jumping buckets, right? You're moving from taxable bucket to tax deferred to tax free. And it's a really nice vehicle because ultimately, one of the blocking points to putting money in a retirement plan that I hear is, well, I can't invest in the things I want to. Well, if you're a note investor and you can invest in notes either personally or in your retirement plan, now you're getting the power of deferral, right? By putting it in your retirement plan.
Mhm.
So, the contribution limits are much higher. I think this year the contribution limit is like it's on the order of $66,000, if you made enough. Um, so it lowers your income tax load.
Mhm.
So again, you get a deduction for it.
Yeah.
And there's a lot of, over the last couple of years, there's a lot of interesting components that have come up with this. So you can make there's two components to the 401k plan contribution. One is a profit sharing, which the company makes, or a match, okay, which a lot of people know about. And the other is the deferral that comes out of your pay. Okay, so if you're self-employed, that's just coming out of your net income. And that could be up to $22,500 in the current year. So that's you can swish away a lot of money.
Yeah. Excellent. Great stuff. And there's more information, I'm sure, at MidAtlanticIRa.com is the website. We've been talking with Jack Kiley. And Jack, thank you so much. Great information for everybody. Do appreciate it.
Well, I appreciate being on your podcast. I really enjoyed it. I like the banter back and forth, obviously, and you got to get out of your hole and come up to DC here once in a while. And
Yeah,
we need.
I was hitting Maryland for a while when my son went to college, but he's
Oh, did you really?
yeah, he went up to outside of Maryland there and went to college, and so we were up there occasionally. Well, we were up there a couple times a year for tennis tournaments and stuff. But he's since graduated and moved out west. Yeah, yeah. So
Kids will
we'll
do
see.
that.
We'll get back up there. I've got some good friends up in that area. I'm sure some people that we know in common up there that I'm still in touch with. But we'll do that. And if I do, I'll make sure to let you know I'm in town.
Excellent.
Let you take me out for a drink or dinner or something.
Or both.
There you go. All right. Thanks, Jack. And thank you, everybody, for listening to the show, as always. And if you enjoy it, please give me a nice rating on there. I appreciate that as well. And look forward to talking with you all again very soon.